Good morning, everyone. Welcome to the special YTube session for CA Foundation. Today, we'll be discussing about the concept related to revenue. So, which is again a very important topic, and lot many questions are asked in every attempt, every examination that you're going to face in uh, CA Foundation. This is applicable for May 2022 or November 2022 attempt as well. So, concept of revenue. All right, concept of revenue. So, before we begin with concept of revenue, I have an important announcement to make. You see, so Unacademy has come up with its flagship program, that is CA Iconic program for CA Foundation aspirants, and it is also meant for CA Intermediate as well. All right, so you'll have all the features of plus that you know about in CA Iconic program, but additionally there'll be a lot of other benefits of CA Iconic program. That will be one-to-one personal coaching to devise a strategy and everything. There'll be one-to-one doubt solving session. Your answer scripts will be evaluated. In fact, there will be three pronged test series mock test that will happen in a very structured fashion that I'll talk about in a while. You'll receive printed books. Industry experts will be coming on the platform to tell you or give you knowledge to interact with you about the changes in the field of CA, and there will be community building platform, a channel, a Discord channel wherein students can communicate. So live classes, of course, you'll have weekly tests, study material, unlimited access. It means you can watch the recorded session as many times as you want, and the courses will be highly structured. So what is the best part of Iconic program is that there's three-pronged approach towards taking mock test papers, so the students can revise while preparing for the subject. Both can do both at the same time. So after completion of 40% of the syllabus, you'll have the first tranche of mock test. Then when 80% of the syllabus is completed, again you'll have mock test, and then after completion of the entire syllabus, you'll get full length mock test to figure out where you stand with regard to your preparation. Every test will be followed by a detailed analysis and evaluation of the paper, and you'll get personal guidance and feedback from the expert. All right, clear? So now, as far as Iconic subscription goes, uh, a 24-month course will cost you 58,000 rupees, 12 months course will cost you 35,000 rupees, 6 months course will cost you 25,000 rupees, but the per month charges, if you see, will be lowest if you take the 24 months. So depending on your convenience, you can choose any, but do not forget to use the code Yeshas Live. Do not forget to use the code Yeshas Live to get additional discounts. And if you want to go for combo subscription which covers both foundation and intermediate classes, then for 24 months you got to pay 66,000, and for 12 months 49,500. Again, here also you can use the Yashash Live code. All right, and on top of that we have a CA Foundation Combat to boost your preparation. For a 60 minutes time period, you'll be given 40 question. It is from 26th December onward, that's from tomorrow, it will happen at 12 p.m. with a 1 crore corpus. So students who score marks will be awarded scholarship. So the first 1 to 3 rank will be given 100% scholarship, then it means you don't have to pay anything when you take any course in Unacademy for the first to 3 rank. Those who score 75%, those who score 4 to 10th rank, they will be given 75% scholarship. Those who score 11 to 15th rank will be given 50% scholarship, and those who score 51 to 100 rank will be given 25% scholarship. Again, to enroll now, please use Yeshas Live as the code. Alright, registration is free, so you can enroll now. For enrollment, you don't have to pay anything. So let's get back to the concept of revenue. Now, if I ask you, what is revenue? Am I audible? Registration is free, so you can enroll. So, what is revenue? See, revenue is nothing but the total income earned by a business. Revenue is what? Total income earned by a business. Alright, sometime. So, does it mean it is equal to profit? The answer is no. Revenue and profit are two different things. In fact, the amount of profit or the quantity of profit or loss is included in revenue. So, revenue includes what? If I say total revenue that includes the cost of production and your profit. So, if the revenue is more than the cost of production, the excess is the profit. If revenue is less than the cost of production, then you are incurring losses. So, when I say total revenue, that is the total income received by any business. Total revenue or TR as we mention it. How do we calculate TR? Very simple. Alright, what is the price per unit of every product that you are selling? So, price per unit into number of units sold. So, the price per unit we write it as P and number of units sold we write it as Q. So, TR is nothing but P into Q. Alright. So, that is your total revenue. It means what is the price of every unit. Say the price of every unit is 10 rupees and I am selling, my business is selling 1 lakh units. So, it means the total revenue will be rupees 10 into 1 lakh units, that will be 10 lakh rupees you will receive. Now, average revenue. See, average of anything is the total of that thing divided by the quantity. If I want to find out average product, then I will divide the total product by input. When I want to find out average cost, then I will divide the total cost by the output. And when I want to find out what is average revenue, then I divide the total revenue by the output. Alright, total revenue by the output. So, average revenue or AR, how can I define average revenue? Is the revenue per unit of output or sales. So, revenue per unit of output or sales. So, if I want to find out average revenue, then what I got to do is divide the total revenue by quantity. Now tell me, can I write total revenue as we have seen before as price into quantity? Of course we can write total revenue is price into quantity, that divided by quantity. So TR by Q, I can also write it as P into Q by Q, is the same thing. Now when I cancel out Q and Q from here, what is left is P. So can I say finally that AR is equals to price or AR is equals to P? Yes, of course. No, so average revenue will also be always be equals to price per unit, always be equal to price per unit. Now, if you want to see a numerical example, let's say that quantity of output. Q is 100 units. So a business is selling 100 units. Price per unit. Price is rupees 20 per unit. It means every unit I am selling will be at rupees 20. So what is my total revenue? We know that price into quantity, price per unit into quantity. What is price? That is rupees 20 into quantity, that is 100 units. So what is the total revenue? Rupees 2000 is my total revenue. Rupees 2000 is the total revenue. So if I want to find out average revenue, what is the formula? Average revenue is total revenue by quantity. So I can write it here as rupees 2000 divided by how many is the units? 100 units. 100 units. So how much you get? You get rupees 20. So AR is equals to rupees 20. So you see, eventually AR and price are the same thing. AR and the price per unit are the same thing. Clear? Alright. So always remember this. And then comes what is known as marginal revenue. Marginal revenue. Marginal revenue or MR. See, marginal is always tries to find out with a change of 1. If I want to find out marginal product when I am studying production function, the marginal product tells us that how many additional units can be produced if input is increased by 1 unit. So 1 unit of input, how many additional extra output? That is marginal product. When I want to find out what is marginal utility, then I'll try to find out how do you find out then what is the change in satisfaction if the consumption increases by 1 unit. It means 1 extra unit gives me how much extra utility, that is marginal utility. Clear? When I want to find out marginal cost, then I try to find out that what is the change in cost if the output changes by 1 unit. So that will give me extra cost or additional cost. Likewise, when I want to find out marginal revenue, then I try to figure out that what is the extent of change in my total revenue if the output changes by 1 unit. So what is the extent of change in the total revenue when output changes by 1 additional unit. So if I have to calculate marginal revenue, then what I have to do is we have to find out change in total revenue by change in quantity. So we can also write it as delta TR. Delta denotes the sign for change in maths, and delta Q, or you can also write it as TRN minus TRN minus 1. You can write it in any manner. Alright, TR of N minus TR of Nth minus 1 unit. So that will give you marginal revenue. Now let's understand the relationship between total revenue, marginal revenue and average revenue. Alright. So a relationship between total revenue, marginal revenue and average revenue. Now remember one thing, that revenue, when I say, I mean is the income of the seller. Now think it in a way. Income of the seller depends upon the consumption by the consumers, because when the consumer consumes any product, the expenditure happens from the part of the consumer, and the expenditure made by the consumer is nothing but end up becoming the revenue of the seller. So can I write here, first of all, important things that you must know before you understand the relationship between TR, NMR and AR, that expenditure incurred by consumers becomes the revenue earned by the sellers or firms. Alright, because when consumers are spending, because if I am a seller and you are a buyer, my revenue depends upon your expenditure. If you spend more money to buy my goods and services, the services and goods and services that I am offering to you, if you are spending more money, then my revenue will also increase. If you are spending less money, then my revenue will decrease. And if you are spending the same amount of money, then my revenue will remain same. And if you are not spending anything, I will not earn anything, because between the seller and the buyer nothing comes. So whatever you spend is whatever I get. Clear? So you increase your expenditure, my revenue will increase. You decrease your expenditure, my revenue will decrease. You spend the same amount of money, my revenue will remain same. And if you don't spend anything, then I will not earn anything. So there is a direct relationship between expenditure of the consumer and revenue of the seller. So we can say that there is a direct or positive relation between expenditure made by the consumers and revenue income of the sellers. So when there is a direct relationship, then I can say that it will be largely the elasticity of demand that will determine whether the revenue of the seller is increasing or decreasing when the price changes. Alright, we will understand this concept in a while. So just now, in fact. So what we know here is that the elasticity of demand, it means what is the degree of elasticity, E more than 1, less than 1 or equals to 1. Elasticity of demand, whether the revenue of the sellers will increase or decrease due to change in price. Right. So let's understand this from the perspective of a schedule. Alright, from the perspective of a schedule. So let's say this is the price, this is the quantity of sales that is happening, this will be your total revenue, then you have marginal revenue. Let's write it even more closer. So that quantity, total revenue, marginal revenue and average revenue. Alright, clear? So let's say I price my product at rupees 10. When I price my product at rupees 10, I am not able to sell even one single unit, let's say. So sales is 0. It means everything will be 0 then. I am not going to wind up my business and leave, because I know that there is a law which is known as law of demand, which says that if I decrease the price, maybe I will be able to increase my sales. So what I'll do, I'll cut down on my profit margin and reduce the price from 10 to 9. The moment when I reduce the price from 10 to 9, I'm able to sell 2 units. I'm taking simple figures, it could be 2 million units you can take. Alright. So it means, what is my total revenue? We know that total revenue is price into quantity. So I can say that my total revenue here is 18. 9 into 2 is 18. What is the marginal revenue? Marginal revenue is change in the total revenue divided by change in the output. So what is the change in the total revenue? My total revenue was 0, which is increasing to 18. So it means the change in total revenue is 18. Correct? Change in total revenue is 18. What is the change in output? I was selling 0 units, now I am selling 2 units. So it means the output is increasing by 2. So change in output, change in total revenue is 18, change in output is 2. So it means I got the marginal revenue as 9, and average revenue is simply TR by Q, so 18 by 2 and 9. So it means AR and MR curve will start from the same point, but they will not remain the same. Now as a seller, what is my most important objective? Is profit maximization, because without maximizing profit, I'll not be able to generate wealth for myself in the long run. So that is the primary objective of every business, to generate. There are other objectives as well, but the primary objective, because if the primary objectives are not met, then all other objectives will fail. So in order to fulfill all other objectives for a business, first it will have to earn profit. Alright. So to maximize my profit, I know I can decrease the price of the product. Now we know that many a times the demand, what it is, but before reducing the price, I have to find out whether the demand is elastic or inelastic. Only when the demand is elastic, I will reduce the price, because what will happen if the demand is not elastic? We'll see this. So when I reduce the price, it means when I'm reducing the price from 9 to 8 rupees, I'm sacrificing 1 rupee of my profit margin. I'm sacrificing 1 rupee of my profit margin. So in fact, the sacrifice that I'm making, the gain should be higher than the sacrifice I've made. Then only I'll be able to increase my total profit. That is, my total revenue must increase. So you see here, when I sacrifice 1 rupee of my margin of profit, then I'm able to sell 3 units. But so the increase in demand, it neutralizes the sacrifice that I've made and gives me relatively more income. So now you see here, total revenue increases to 24. So what is the change in marginal total revenue? From 18 to 24 it has increased. So we can say that the change in total revenue is 24 minus 18. What is the change in output? Change in output is 1. From 2 to 3 I am increasing. So it means what I'll get here as 6. Correct? So my marginal revenue is 6. And what is average revenue? Average revenue will be 8. You see, average revenue, this one will always be equals to price. Alright, the moment production starts. Okay. Next. So you see, total revenue has increased when I have reduced the price. It means that the demand is elastic. How do I know that? How do I know that? Let's understand this concept before we go further in the table. In case of total outlay method, we have known that, we have seen also and through various examples, that when demand is elastic and price decreases, then the total expenditure of the consumer will increase. What we have learnt here is that when the demand is relatively elastic and price fall, then what will happen? Total expenditure of consumer will increase. Total expenditure of the consumer will increase. And I've told you that total expenditure and total revenue are directly related. It means when the consumer is spending more money, then the sellers will earn also more money. It means I can say that total revenue of seller will also increase, up arrow increase, clear, total revenue. But how does it happen? Let's say E is more than 1. When I say E is more than 1, so it means what? If suppose price reduces, let's say by 10%, it means quantity demanded must increase by more than 10%, then only you will get E more than 1 under proportional method. How did we find out elasticity? If you remember, percentage change in quantity demanded divided by percentage change in price, isn't it? Percentage change in quantity demanded divided by percentage change in price. So when price is reducing by 10%, then quantity demanded must increase by more than 10% in order for elasticity to be greater than 1. Alright, let's say it increases by 15%. You can increase it by 11%, 12%, 15%, 20%, 30%, whatever, but more than 10%. I've taken a simple figure here. So now think that a consumer is saving how much? 10%. Consumer is saving 10%. So when he's saving 10%, with this 10% of saving, he will be able to buy more or less 10% of the commodity. So what he does, he purchases 15% extra. It means I know that 10% of my saving can help me buy approximately 10% of the goods, but I'm buying 15% more. It means, am I spending more money or less money? I'm spending more money. Of course, my saving is going to help me buy more, but my savings of 10% is not going to help me buy 15%. So it means I am spending more than I'm saving, correct? When I'm spending more than I'm saving, then my total expenditure increases, no? Alright. It means my total expenditure increases, and when total expenditure increases due to direct relation between total expenditure and total revenue, then total revenue will also increase. So that's what is happening here. You see, when I'm reducing the price and the total revenue is increasing, it means whatever I'm giving up, sacrificing the profit margin, the consumers are giving me back more than what I have sacrificed in terms of my profit margin from 9 to 8 rupees. So my total revenue, rather than falling down, it is increasing. Alright, just think it logically. If I give 20% discount and the sale at my shop increases by 50%, will I lose? No, I will gain. Alright, clear. So I will, as I've told you, a businessman always tries to maximize the profit. He will continue to hunt for profit. He will further reduce the price, and when he is further reducing the price from 8 rupees to 7 rupees, then he finds out that the total sales increases to 4. So it means now what is the total revenue? 7 into 4, that is 28 rupees. So it means again the total revenue is increasing, and also remember, total revenue is the summation of marginal revenue. It means if total revenue is increasing, then marginal revenue must be positive. Must be positive. It should not be negative, because if marginal revenue is negative, it will take away from the total revenue. So you see, now what is the additional revenue I have generated? 4 rupees. Again, as I have told you, average revenue will always be equal to price. So 24 divided by 8 will be 7. I will again reduce the price from 7 rupees to 6 rupees. And I find out I am selling 5 units. Still I am getting 2 rupees more. So it means still I have a positive revenue, positive marginal revenue 2. So average is 6 here. Now when I reduce the price further to 5 rupees, I am able to sell more. See, the law of demand will not be violated. When I am decreasing the price, quantity demanded will increase. But you have to find out whether the increase in demand, will it give me more than the sacrifices I have made or not. Right now it doesn't. Alright, so when I reduce the price further, my sales is increasing, but the increase in sales only will take care of the sacrifices I have made, gives me nothing extra. So it means total revenue is 30. When total revenue is not changing, it means there is no addition to total revenue, so marginal revenue has to be 0. You see, 30 minus 30 is 0, divided by 6 minus 5, and average cannot be 0, so 30 by 6 is 5. Alright, because average revenue is equals to price. Now I will apply the full stop here, because if I go further, then there will be a problem, because now if I reduce the price further to 4 rupees, again the quantity demanded will increase, but the thing is, increase in demand doesn't actually neutralize the sacrifices I've made in terms of profit margin that I've reduced. So what will happen? You see, total revenue starts to fall down. So it means when total revenue is falling, it means it has to be so that marginal revenue has to be negative, because marginal revenue and total revenue, what is the relationship? Total revenue is the summation of marginal revenue. So here you have minus 2. Averages cannot be negative, as I've told you, because average revenue equals to price. So you'll get 4 rupees here. Clear? Alright. So now let's figure out. Here, up from this point up till this point, you see, with the decrease in price, the total revenue is increasing. It means with the decrease in price, I can say total expenditure of the consumer is increasing. That's how total relatively more elastic. That is E greater than 1. Got it? E greater than 1. But you see, next one, from this point to this point, what is happening? What we can conclude is that as price falls, total revenue does not change. So when total revenue is not changing, it means I can conclude that the demand is unitary elastic. That is E equals to 1. E equals to 1. How did I know it? So let's consider it from the perspective of a consumer. If I say E is equals to 1, unitary elastic demand, it means if you look at the proportionate method, what it says, percentage change in quantity demanded is equals to percentage change in price. So what does it say? Unitary elastic demand is that percentage change in quantity demanded is relatively same as percentage change in price. Correct? That's what the E equals to 1 states. So it means when E is equals to 1, and I reduce the price, let's say by 10%, it means quantity demanded must increase by approximately 10%. So think in this way, when a seller is reducing the price, from the consumer's perspective, you've seen, he will be saving how much? He will be saving 10% of his income, because 10% is discount, and he will use the savings only to buy something extra. It means I save 10 rupees and I will buy for extra 10 rupees. If I am saving 100 rupees, I will buy extra for 100 rupees. It means whatever I am saving, that much I am spending. So do you think the sellers are earning anything extra? No. So it means if the seller are sacrificing 1 rupee of their profit margin, they are getting 1 rupee back. It means whatever the consumers are spending is equal to their saving. So increase in consumption by 10%. It means sellers are spending whatever they are saving, not more, not less. I save 10%, I spend 10% extra. If I save 20%, I'll spend 20% extra. Whatever I'm saving, I'm spending the same amount. It means actually, is the consumer spending anything extra? Now consumption is more, but I'm not spending anything extra. If the petrol price was 70 rupees, is 100 rupees, and if it falls down to 80 rupees, then I'll still buy 100 rupees of petrol. So fall in price is 80 rupees. I'm saving 20 rupees. I will use this 20 rupees to buy something extra, because now the price is 80 rupees. I'll get 100 rupees worth of quantity in 80 rupees. So the extra 20 rupees I'm saving, I'm spending that only. So it means the expenditure of the seller is not changing. So there is no change in the expenditure of the consumer. And when there is no change in the expenditure of the consumer, it means the consumer is spending the same amount of money. I can other way say that consumers are spending the same amount of money as before. So I can also conclude that it means what? It means sellers are also earning same amount of revenue as before. It means the revenue of the seller is not increasing, and you see that's what happened here. That's what happened here. So the price is decreasing from 6 to 5, but the total revenue is not increasing, because the increase in demand is only going to give me back what I have reduced as a part of my profit margin in terms of cost selling price of the commodity. But in the third situation, what happens? In the third situation, you see, when the price further falls down, what happens? There is a fall in the total revenue. So what happens here? Now when price reduces, then total revenue also fall. It means this points to the fact that the demand is inelastic. It points to the fact that demand is inelastic. So demand is inelastic, it means E less than 1. Expenditure of the seller is reducing, it means consumers are spending less amount of money. So we say that when a reduction in price by sellers also reduces their total revenue, then the demand is inelastic. When I say E less than 1, which is also known as a relatively inelastic demand, relatively inelastic demand, it means what I can say is that percentage change in quantity demanded is relatively less than the percentage change in price. Alright, clear. So if say E is less than 1, if E is less than 1, it means if suppose the price is reduced by 10%, then quantity demanded will increase, but by less than 10%, let's assume it to be 5%. So it means what is happening is that when the price is reducing, the consumers are saving 10%. It means I'm saving 10 rupees or 100 rupees, whatever it is. But out of that 10 rupees or 100 rupees, only half of that I'm spending. So it means the other half remained in my pocket. So since the price is falling down, I'm saving, but I'm not spending the entire part of my saving. I'm saving, but I'm spending little more, little less than what I'm saving. Alright, so it means there is an increase in consumption. Consumption is increasing, but am I spending the entire sum of money that I've saved? If the price of petrol was 100 rupees, it falls down to 80 rupees. I use to buy more than what you was buying. Now I can buy 1 liter at 80 rupees. So at 90 rupees I'll get more than 1 liter. So I'm spending 90 rupees. But don't you think 10 rupees is left in my pocket? So it means a discount of 20 rupees was given to me by the seller. I'm saving 20 rupees of discount, but I'm spending only 10 rupees extra on that discount. It means from the seller's side they are losing 20 rupees but gaining 10 rupees. It means 10 rupees is the loss of revenue for them. So it means I can say that in this case you're saving 10%, but you're spending part of your saving only. You're increasing your consumption by 5%. So it means the total expenditure of consumer, there is again the video got stuck, I suppose. Alright, now it's fine. So total expenditure of the consumer is reducing, correct? So total expenditure of the consumer is reducing. It means consumers are spending less. It means total revenue of sellers will also reduce, correct? So that's what is happening here as well. You see, when I have reduced the price from 5 to 4, when I have reduced the price from 5 to 4, the total revenue is actually reducing from 30 to 28. So I am losing. Why? Because the consumers are spending less sum of money. Alright. Now if I have to plot it into a diagram, how does this diagram look like? Let's figure it out. So this is on the y-axis we have taken revenue, on the x-axis the quantity. Alright, or so basically we try to find out that with regard to sales my revenue is increasing or decreasing, and it's one diagram I'm dissecting into two so that it's easier for you to understand. Alright, so this is your AR, this is the MR. MR will always fall sharply. Now let me draw an imaginary line here where the MR curve cuts the x-axis, and then I will draw the total revenue curve. This is your TR curve. Now let's mark the point. So you see here, at this point you have MR equals to 0, and we have seen MR is 0 at the point where TR is maximum. So TR is, after reaching maximum 30, it remains at 30 at the next level of output. So here, that is your TR is maximum, is maximum. This is also known as the point of saturation. Why? Because from this point onwards, the MR will become negative and TR will start to fall. Till the time MR is positive, TR will continue to increase. And when TR is increasing, I can say that with the decrease in price, if TR is increasing, it means demand is elastic. So I can write here E is greater than 1 here. At the point when TR is maximum and it is not changing for the next unit, I can say that E is equals to 1, as we have seen from the schedule. And then when TR is falling, I can say that E is less than 1. Here also, till the time MR is positive, TR will increase. You see, till the time MR is positive, TR will increase, because TR is nothing but the summation of MR. So TR is going to increase. Alright, but so I can say that E is greater than 1 also. When MR is positive, it means TR is increasing, so E is greater than 1. When MR is 0, TR is not changing, that means at that point E will be equals to 1. And when MR breaches the x-axis and it becomes negative, MR is negative, then E will become less than 1. So what you can see from or learn from this diagram is that as the TR is increasing, MR is falling but it remains positive. The reason why TR is increasing is because MR is positive, because MR and TR relationship, I have told you the TR is a summation of MR. After some point, you see TR becomes constant, as we have seen from the table, 30-30 at two places. At that point, MR is not changing, say it means MR becomes 0. So it means MR is 0 or TR is not increasing, it means elasticity has to be equals to 1. Alright, elasticity has to be equals to 1. And when TR starts to fall down, E becomes less than 1. It means MR has to be negative, because if TR is the summation of MR and TR has started to fall down, then MR has to be negative to take it away the value from TR. So I think there is some problem with the connection. I hope I'm audible. Alright. So demand, desire or willingness to buy. Now why will I be willing to buy anything? It must have a utility for me. It must have some satisfying power for me, because otherwise if any commodity doesn't have any utility for me, will I buy it? Let's say I don't like burger. I may have all the money which will help me buy 10 burgers, but I don't like it. When I don't like any product, does it mean that it has commodity as utility for me? The answer is no. It may have utility for many people who like it, alright, but I don't have the utility, so will I buy it? The answer is no. So it means I'll be willing to buy, and my willingness to buy depends upon the satisfaction that I'm going to derive from it. So the higher the satisfaction I'll derive, then my demand will be more for that commodity. As I go on consuming one unit after another continuously, So I will be getting satisfied with every unit I consume. So my willingness to buy will also continue to decrease. Some point in time I am totally satisfied, so willingness is also a demand curve. But only desire or willingness to buy will not create demand. I must have the ability to pay. So there should be ability to pay. Now ability to pay depends upon what? The price and my income. If the price is affordable considering my income, then I have the ability to pay. If the price is unaffordable and it is beyond my budget line and beyond my income, then I don't have the ability to pay. In that case, I can have a desire to buy, but I cannot afford to pay for it. So again, the demand is not created. Alright, I should have the ability. So when both willingness to buy is there and ability to pay is there, then only a demand is created. And ability to pay, as I've told you, my ability to pay depends upon the price of the commodity, whether my income permits that price or not. So ability to pay depends upon price of the good, and we know that price is equals to average revenue all the time. So that's the reason we call AR curve also as the demand curve, because as AR curve is falling, it means the price is reducing, the demand is increasing. Right, means what? As AR decreases, it means what? It means the price is decreasing, because AR is equals to price, and when the price decreases, there will be increase in quantity demanded. So that's why AR curve is also known as the demand curve for the consumer. I hope this session has been useful for you. So you'll get around 2 to 3 questions from the concept of revenue. You cannot miss out on those. So I'll come back with another special session very soon. Till then, bye-bye, and please, if you have not subscribed to Unacademy, please download the app. At least you can watch the special sessions and then make up your mind whether you want to subscribe or not. I bet you will subscribe. Alright, bye-bye, take care and have a nice time.